April 15, 1998. After the market closed, a press release from Cendant Corporation crossed the wire. It disclosed what the company called accounting irregularities discovered in the business units that had belonged to CUC International, one of the two companies that had merged 4 months earlier to form Cendant. The next morning, the stock lost roughly $14 billion in market value in a single session. At the time, the largest single-day collapse attributable to accounting fraud in United States history. Inside the company's Stamford, Connecticut offices, auditors from Arthur Andersen began pulling documents on a specific line item: the membership cancellation reserves that had been reversed into reported income quietly for years. The question this episode answers is how a reserve account, an entry designed to be conservative, became the engine of a $500 million revenue fabrication. Most accounting fraud discussed on this channel works in one direction. Management wants reported earnings to be higher than economic reality, so they pull revenue forward, defer expenses, or hide liabilities. The reserve manipulation at the center of the CUC case ran through a mechanism that is subtler, because it begins with an account that exists to be pessimistic. Start with what CUC International actually was. CUC was a membership-based business. It sold consumers access to shopping, travel, and dining discount clubs under names like CompU Card, Shopper's Advantage, and Traveler's Advantage. A customer would enroll, often through a trial period, and pay an annual membership fee. The business model had a structural feature that matters enormously here. Memberships were routinely cancelled. Customers signed up during a trial, decided the service was not worth the fee, and demanded refunds. Cancellation rates in membership businesses of this kind were high and predictable. This is where the relevant accounting device enters. Under the revenue recognition rules that applied, CUC could not simply book the full membership fee as revenue the moment a customer enrolled. Because a portion of those customers would cancel and receive refunds, the company was required to estimate the expected cancellations and establish a reserve, a liability, against the revenue it had recognized. This is a membership cancellation reserve. Its legitimate function is straightforward. If you sell 100 memberships at $100 each, and experience tells you 20% will cancel and demand refunds, you do not report $10,000 in revenue. You report the revenue net of an $8,000 expectation, holding $2,000 in reserve against the refunds you know are coming. The reserve is, by design, an estimate. It is management's judgment about future customer behavior. And this is the structural vulnerability. Because the reserve is an estimate rather than a documented transaction, it occupies a zone of accounting discretion. A more conservative estimate produces a larger reserve and lower current income. A more aggressive estimate produces a smaller reserve and higher current income. The account is inherently soft. Now consider what happens over time. A reserve established this year against expected cancellations will, in future periods, either be used, meaning customers actually cancel and the reserve absorbs the refund, or released, meaning the anticipated cancellations did not materialize and the reserve is reversed back into income. That reversal is a legitimate accounting event. If you reserved for 20 cancellations and only 15 occurred, the reserve for the other 5 was, in hindsight, too large, and reversing it into income is correct. Here is the mechanism the SEC enforcement record establishes at CUC. The reserves were not being released because cancellation experience came in better than expected. The reserves were being deliberately established at inflated levels and then reversed into operating income on a schedule that had nothing to do with actual customer cancellations. The reserve became a storage container for income. Management built up cushions of reserves in periods where earnings were strong and drew those reserves down into reported income in periods where earnings would otherwise have fallen short of analyst expectations. Financial analysts have a name for this practice. It is called cookie jar accounting. You put earnings into the jar in good times by over-reserving, and you take earnings out in bad times by releasing the reserve. The title of this episode calls it The Cookie Jar in Reverse, and the reason is precise. The conventional cookie jar smooths earnings within the range of what the business actually produces. What the record establishes at CUC went further. The reserves were not merely a smoothing device drawing on real income. They became a source of fabricated income, reversed into earnings to meet targets that the underlying business had not produced. The jar was not being filled with real cookies and rationed out. The jar was being filled with entries that had no economic substance, and those entries were being counted as profit. What made this mechanism durable is that a cancellation reserve is exactly the kind of account an auditor finds difficult to challenge. It is an estimate. Estimates are the province of management judgment. An auditor can question whether an estimate is reasonable, but as long as there is a plausible story supporting the number, the estimate is hard to dislodge. And CUC's business generated enormous volumes of memberships and cancellations, which meant the reserve balances were large, the underlying data was voluminous, and the assumptions embedded in the estimate were numerous. Complexity is cover. So the baseline is this. A legitimate account, the membership cancellation reserve, designed to make revenue recognition more conservative, was inverted into a tool for making revenue recognition more aggressive. Now we walk through how the architecture was built. The scheme did not begin with the 1997 merger. According to the SEC's enforcement findings, the accounting irregularities at CUC International extended back more than a decade before the fraud was disclosed. The practices were long-running and, critically, they were organized. This was not a single rogue entry in a single quarter. It was a system for producing predetermined earnings numbers, operated across multiple reporting periods. Consider the structure step by step. Step 1. The earnings target. CUC's senior management, according to the SEC, began each reporting period with a target. The company was a market favorite. It had a record of consistent earnings growth, and Wall Street had priced that consistency into the stock. Consistent growth is a demanding master. To sustain the multiple, management needed to report numbers that met or exceeded expectations period after period. The target was not derived from operations. Operations were then adjusted to hit the target. Step 2. The gap. At the close of a reporting period, management compared the earnings the business had actually produced against the target. When actual results fell short, and the record indicates they frequently did, a gap existed between reported reality and the number that had to be published. Step 3. The reversal. The gap was closed using entries. The SEC's findings describe a range of techniques, but the membership cancellation reserve was central. Reserves that had been established in prior periods, ostensibly against future cancellations, were reversed into current income to fill the gap. Because the reserve was an estimate, Reversing it required only a management judgment that the reserve was now larger than needed. No new transaction had to occur. No customer had to actually decide not to cancel. An accounting entry moved a number from a liability account into revenue or into a reduction of expense, and reported earnings rose to meet the target. Step 4. The concealment through allocation. A single reserve reversal of a few $100,000 is visible. A pattern of reversals timed precisely to earnings shortfalls is a fingerprint. The record indicates the adjustments were spread across business units and account lines to reduce the visibility of any single entry. Fabricated income was distributed rather than concentrated. This is a recurring feature of durable accounting fraud. The distortion is disaggregated to defeat the analytical procedures that look for anomalies in specific accounts. Step 5. The merger reserve. This is where the architecture becomes most instructive, and it connects directly to the events of April 1998. CUC was acquisitive. It bought other companies. Under the purchase accounting rules that applied at the time, when a company acquired another, it could establish reserves at the moment of acquisition for anticipated costs of integrating and restructuring the acquired business. These are merger reserves or restructuring reserves. The structural feature that made merger reserves so useful to a scheme like this is that they were established through the balance sheet at the moment of acquisition, not through the income statement. When you set up a merger reserve, you do not take a charge against current earnings. You allocate purchase price. So a company could establish an enormous reserve at the time of an acquisition without any of it appearing as an expense on the income statement. And then, in subsequent periods, that reserve could be released into income, exactly like the cancellation reserve, to fill earnings gaps. The SEC's findings describe both mechanisms operating. Cancellation reserves derived from the ongoing membership business and merger reserves derived from acquisitions both functioned as sources of stored, releasable income. A company that acquires frequently is a company that establishes merger reserves frequently, which means it maintains a continuous supply of releasable reserves. Acquisitiveness and reserve manipulation are structurally complementary. Each acquisition refreshed the jar. Step 6. The December 1997 merger itself. In December 1997, CUC International merged with HFS Incorporated to form Cendant. HFS was a franchising company. It owned brands including Avis, Ramada, Howard Johnson, Century 21, and Coldwell Banker. The combination created a consumer services conglomerate with a large market capitalization and, crucially, a large expected pool of merger-related reserves. The record indicates that the CUC side of the combined entity sought to establish substantial reserves in connection with the merger. A merger of this scale generates a correspondingly large opportunity to book restructuring and integration reserves, and those reserves, once established, become available for future release. If you draw the org chart the SEC's findings support, it looks like this. At the center, the reporting entity, first CUC International and then Cendant. Below it, multiple membership businesses generating real revenue and real cancellations, and therefore legitimate cancellation reserves. Alongside them, a stream of acquisitions, each generating merger and restructuring reserves through purchase accounting. Above the operations, a management apparatus that set earnings targets and directed adjusting entries to reconcile actual results with those targets. And running through all of it, the reserve accounts functioning not as conservative estimates, but as reservoirs of releasable income. The magnitude the record establishes is substantial. When the restatement was completed, Cendant restated its pre-tax income for the affected periods by amounts exceeding $500 million in fabricated or improperly recognized income. The title of this episode references $500 million, and that figure sits within the scale of the restatement the company ultimately reported. This was not a rounding adjustment. It was a material portion of the reported profitability of the CUC business. The essential structural point is this: every entry in the scheme was, considered in isolation, defensible as an exercise of accounting judgment. A reserve reversal is a normal accounting event. A merger reserve is a normal purchase accounting device. The fraud was not in any single entry. The fraud was in the pattern and the intent. Entries made not because the underlying economics justified them, but because a predetermined earnings target required them. This is why the mechanism is so difficult to detect. There is no forged document, no fictitious customer, no fabricated invoice at the core of it. There is a systematic bending of legitimate discretionary accounts toward a target. Which brings us to the detection failure, and it is a case study in why the verification chain around discretionary accounts is structurally weak. CUC International was audited by Ernst & Young during the years the scheme was operating. The relevant question is not whether the auditors were negligent as individuals. The forensic question is structural. What would have had to be true for the audit process to catch this, and why was that condition absent? Consider what an auditor does with a reserve. The auditor evaluates whether the reserve estimate is reasonable. To do that, the auditor examines the assumptions, tests the underlying data, and assesses whether the resulting balance falls within a defensible range. The critical word is range. Estimates do not have a single correct answer. They have a range of reasonable answers. If the true expected cancellation liability is somewhere between 8 and 12% of membership revenue, then any reserve within that band is arguably defensible. An auditor who finds the reserve at 11% has little basis to insist it should be 9. This is the first structural weakness. Reserve accounts are validated against a range, and management can operate anywhere within that range and even somewhat beyond it, while presenting a plausible narrative. The discretion that makes the reserve legitimate is the same discretion that makes it manipulable. The second structural weakness concerns the direction of reserve testing. Audit procedures are historically oriented toward the risk that a company understates its reserves, because an understated reserve overstates income and overstates the company's health. Auditors are trained to be skeptical of reserves that look too small, because too small reserves flatter earnings. But the CUC mechanism, in the reserve building phase, worked by making reserves too large. Over-reserving is conservative. It understates current income. An auditor who encounters a reserve that appears larger than strictly necessary may view it as prudent, not as suspicious. Conservatism does not trigger audit skepticism. It relaxes it. Here is the trap. The over-reserving phase looks conservative and passes review. The later reversal phase, when the excess reserve is released into income, looks like the normal true-up of an estimate that proved too large. Each phase, viewed alone, is unremarkable. Only the two phases viewed together over multiple periods reveal the pattern. Reserves systematically built when they can be spared and released precisely when income is needed. And audits are conducted period by period. The annual audit examines the current year. The structural mechanism operated across years. The unit of the fraud was larger than the unit of the audit. The third structural weakness was distribution. As noted, the record indicates adjustments were spread across business units and account lines. Audit sampling and analytical review flag anomalies that concentrate. A large unexplained swing in a single account draws attention. A modest adjustment distributed across a dozen accounts does not exceed the threshold in any one of them. Materiality is assessed against the financial statements as a whole, but the individual entries were sized to stay beneath the level that would draw scrutiny to any single item. The fraud was engineered against the audit's own detection thresholds. Now, consider the analysts and the rating agencies, the market-facing gatekeepers. CUC and later Cendant were widely followed. The company had a reputation for consistent, predictable earnings growth. Consider what that reputation meant analytically. An analyst who observes a company reporting smooth, consistent earnings quarter after quarter has two possible interpretations. One, the business genuinely produces smooth, consistent results. Two, the reported smoothness is manufactured through the management of discretionary accounts. The problem is that smoothness itself is what the market rewarded. The consistency that should have been a warning sign was instead the basis of the premium valuation. The very pattern that a forensic analyst would flag was the pattern the market was paying for. This is a recurring structural feature in reserve manipulation cases. Earnings smoothing produces the appearance of low-risk, high-quality earnings. Low-risk, high-quality earnings command a higher multiple, so the manipulation is self-reinforcing. It generates exactly the market perception that makes the stock more valuable, which raises the stakes for continuing to produce the smooth numbers, which deepens the reliance on the reserve mechanism. The fourth structural weakness emerged only at the merger. When HFS combined with CUC to form Cendant in December 1997, the transaction brought new people into the financial reporting of the CUC businesses. HFS management and their advisors now had reason to examine the CUC accounts, not as external auditors constrained by the range of reasonableness problem, but as new owners with an incentive to understand what they had acquired. The integration of two accounting organizations is a moment when the internal narrative that sustains a long-running scheme becomes exposed to people who did not build it and do not share its assumptions. This is the condition that had been absent for a decade. A set of eyes inside the company with both the access and the incentive to question the reserve practices. What would have had to be true for earlier detection? Someone would have needed to examine the reserve accounts not period by period, but longitudinally across multiple years, and to correlate the timing of reserve reversals against the pattern of earnings shortfalls. The signature of the fraud is in that correlation. Reversals clustering precisely when income was needed. That is a specific analytical procedure, and it was not part of the standard audit or the standard analyst model at the time. Detection required looking at the account across time as a system, which is precisely the view that the period-by-period structure of financial reporting and auditing does not naturally produce. The unraveling followed from the merger, and the sequence is documented. In the months after the December 1997 combination, the integration of the two companies proceeded. The record establishes that concerns about the CUC accounting practices surfaced during this integration period. On April 15, 1998, Cendant issued the press release disclosing accounting irregularities in the former CUC business units. The disclosure was not a full accounting. It was an initial acknowledgement that the reported results of the CUC operations could not be relied upon and that the company was investigating. The market's response was immediate and severe. The following day, Cendant stock fell sharply, erasing roughly $14 billion in market capitalization. This was, at the time, the largest one-day loss of market value connected to accounting fraud. The scale of the loss reflected the structural nature of the deception. Investors had paid a premium for consistent, high-quality earnings. When the disclosure revealed that a material portion of those earnings had been fabricated through reserve manipulation, the premium collapsed because the entire basis of the valuation, the reliability of the earnings, had been invalidated. The loss was not proportional to the fabricated income alone. It was proportional to the loss of confidence in everything the company had reported. The board of Cendant responded by commissioning an investigation conducted by the audit committee with outside counsel and forensic accountants. This is the standard institutional response to a disclosure of this kind, and it produced the detailed reconstruction of what had occurred. The investigation examined the reserve accounts, traced the reversals, and quantified the impact on reported earnings across the affected periods. The company subsequently restated its financial results. The restatement removed the fabricated income and corrected the reserve treatments. The magnitude of the restatement placed it among the largest of its era. The company also faced a wave of shareholder litigation, which it ultimately settled. The settlement of the securities class action against Cendant was, at the time, among the largest such settlements on record. That figure reflects the aggregate loss suffered by investors who had purchased securities at prices inflated by the fabricated earnings. The Securities and Exchange Commission pursued enforcement action. The SEC's findings established the nature and duration of the scheme, that senior officers of CUC International had directed a long-running effort to inflate reported earnings, that the membership cancellation reserves and merger-related reserves had been manipulated to meet predetermined targets, and that the practices extended back well before the merger. The enforcement record identifies the reserve manipulation and the systematic adjustment of reported results as the core of the fraud. The collapse of the mechanism, once exposed, was total, and the reason is structural. A reserve manipulation scheme depends on the continuous availability of releasable reserves and on the market's continued belief in the reliability of reported earnings. The disclosure destroyed the second condition instantly. Once the market understood that reported earnings had been fabricated, it could no longer distinguish real income from released reserves in any prior period. Every reported number became suspect. The restatement then formalized what the disclosure had implied, that the smooth earnings history was, in material part, an artifact of accounting entries rather than a record of economic performance. There is a further structural point in the unraveling. The scheme survived for more than a decade while CUC operated as an independent company with a stable set of auditors and a consistent internal narrative. It did not survive its first year inside a merged entity. The merger introduced the one thing the scheme could not withstand: independent examination by parties with the access to see the accounts and the incentive to question them. This is a general property of long-running internal fraud. It is most vulnerable at moments of organizational discontinuity, when new owners, new management, or new auditors bring an outside frame of reference to accounts that had been governed by an internal consensus. The merger that created Cendant was also the event that exposed the fraud that had lived inside one of its predecessors. What does the Cendant case establish about the mechanism? First, it establishes that the most dangerous accounting frauds are not those built on fictional transactions, but those built on legitimate, discretionary accounts operated outside their intended purpose. A cancellation reserve is a proper and conservative device. A merger reserve is a proper purchase accounting device. Neither is fraudulent in itself. The fraud existed entirely in the pattern of their use, in the systematic direction of discretionary entries toward predetermined targets. This makes such frauds structurally resistant to detection because there is no single false document to find. There is only a pattern, and patterns are visible only across time and across accounts, which is precisely the view that period-by-period reporting and auditing do not naturally produce. Second, it establishes the inverse relationship between apparent conservatism and detectability. Over-reserving looks prudent and passes review. The manipulation is loaded during the phase that appears most conservative and harvested during a phase that appears to be a routine true-up. An audit oriented toward the risk of understated reserves is structurally poorly positioned to detect a scheme that begins with overstated ones. Third, it establishes that earnings smoothness, which the market prices as a virtue, can be the visible surface of manipulation. The consistency that earned CUC its premium was the same consistency that a forensic examination would treat as a red flag. The market's reward structure and the analytical warning sign pointed in opposite directions. The regulatory response was consequential. The Cendant matter arrived in the same period during which the SEC's attention to earnings management and reserve manipulation intensified. In 1999, the Commission issued guidance addressing materiality and the use of reserves to manage earnings, reflecting a broader concern that quantitatively small entries could be qualitatively material when they were used to meet targets or manufacture trends. The recognition that a reserve reversal timed to close an earnings gap is material regardless of its size because it reflects an intent to mislead is a direct structural lesson of cases built on discretionary accounts. The manipulation of reserves to meet targets became an explicit focus of enforcement, and the treatment of restructuring and merger reserves under purchase accounting drew increased scrutiny in the standard-setting process that followed. The finding, stated as a forensic review states its findings, is this. The membership cancellation reserve at CUC International was designed to make revenue recognition conservative. It was inverted into a mechanism for making revenue recognition aggressive, functioning as a reservoir of fabricated income released on a schedule dictated by earnings targets rather than by customer behavior. The mechanism was durable because it operated through legitimate discretionary accounts, distributed its distortions to defeat detection thresholds, and produce the smooth earnings the market rewarded. It collapsed not through routine gatekeeping, but through the organizational discontinuity of a merger, which introduced examiners with the access and the incentive to question accounts that had been governed for more than a decade by an internal consensus. The $500 million restatement measured the distance between the reported earnings and the economic reality the reserves had been used to conceal.